Welcome back to China's stock market. This is a weekly wrap. I am your host, Jack Kuzi, and as always, every week, well, most weeks anyway, we wrap up what's going on in China's financial markets on the mainland and in Hong Kong. And it's been a bumpy week. It's been a bumpy week in particular for global markets. We saw the historic moves in Asia, particularly on the Japanese index, a fall of 12.3% or roughly there. We've seen markets very volatile off the back of weak data coming out of the US, particularly around its employment data, on the back of the BOJ or the Bank of Japan raising rates, and a world that was very, very volatile this week. And we're going to cover it from a Chinese aspect. I filmed this in two parts. If you're listening on podcasts, you don't care. If you're watching on YouTube, you will notice a different background. I am traveling today. I'm flying out, so I did want to finish it off. So I did the first part a couple of days ago. So you'll see me in a white shirt in my office. And now I'm in my kids' playroom in my house here, doing it at 5:50 a.m. in the morning. But I do want to keep it consistent. A bit of a shorter show this week. We're going to wrap up quick hits as always, we always do. And we're just going to look at particularly China's reaction to the turmoil in global markets and how it's reacted and why it's kind of been a little bit insulated and why this could be a turning point for Chinese equities. I'm not going to say it is, but why it could be a turning point for Chinese equities. With that said, let's get into it. Let's just talk about the disclaimer first. Remember, the videos and its context are provided for information purposes only. They don't constitute a recommendation or a recommendation to purchase or sell securities. Just remember that I try to keep it as factual as possible. However, a lot of this is my own personal opinion, and it might not be accurate sometimes because it's my personal opinion, and it might not be complete or up to date. Do your own research, but thank you for tuning in. If you are tuning in for the first time and you haven't subscribed, please subscribe to the channel. If you're listening to us on podcast, I think we got 3 views on podcast last week. Let's keep building those numbers, and certainly the YouTube numbers are building up. Let's run through what we're going to do. We're going to do market performance as always. Changed up market performance, going to compare it to a few other markets. Quick hits, 20-point plan out of China and the Politburo, in particular off the back of fiscal stimulus that we saw yesterday. China v. the world, how China reacted to global market turmoil, and what could possibly be the Great Unwind. All right, let's take a look at market performance. So let's have a look at, the first 3 on top, if you're listening or watching on YouTube, you see the SSC, the Shenzhen, and the Hang Seng, courtesy of TradingView. And then we've got Dow Jones, NASDAQ, S&P. I did have the Japanese topics in there, but obviously didn't put it in last night. If you look at it, so the week performance, 2.39 for the SSC, Shenzhen 3.66, Hong Kong 2.52. If you compare it to its American brothers or cousins, 4.92 on the Dow Jones, 7.45 on the NASDAQ, and S&P 500, 5.56. Now, this is Friday to Thursday. When I woke up this morning, the US market was in its close. And when I had a look at it, I'll just look at it live right now. US market, well, the NASDAQ was up 2.78%. It's a significant bounce. We probably should see China bounce off the back of that on Friday's trading. In terms of the monthly performance, not bad for Chinese markets. 1.17 for the SSC, a lot more insulated local mainland markets because there's no foreign investors in there unless you're going through that southbound connect through Hong Kong. 1.19, Hang Seng 3.37, Dow Jones 1.69, the NASDAQ down 11.84% for the month in correction territory there, and the S&P down 6. Let's take a look at our first look at quick hits for this week. First one is Xiaomi rejoins global top 10 smartphones. So in the second quarter, Xiaomi, which is China's second largest phone maker behind Huawei, of course, and the 4th largest phone maker in the world. Actually, I think it's, since the Huawei ban a couple of years ago, Xiaomi definitely came back. But then I take a look at Huawei's Mate 6, and I think they've retaken as China's largest selling smartphone maker. Anyway, it's number 1 or number 2, and either number 3, 4, or 5 globally to obviously Apple and Samsung. It's made a comeback in the global top 10 best-selling smartphone list after being absent for 2 consecutive quarters, which is dominated by Apple and Samsung, according to Counterpoint Research latest global monthly sales tracking report. So I think this was quite interesting. So Xiaomi was the only other brand on the list with its budget-friendly mid-ranger Redmi 13C 4G smartphone. I mean, geez, trying to use 4G now in the world of 5G almost feels like you're using 3G, and using 3G was almost using like 2G when 4G came around, which is, I guess, imperative of the global consumer. So in the second quarter, and I just thought this would be interesting, in the top 10 best-selling smartphones was number 1, iPhone 15, 4.1%. This is globally. Number 2, iPhone 15 Pro Max, 3.7. iPhone 15 Pro, 3.1. So Apple dominating top 3 and accounting for 15% of global smartphone sales. Samsung Galaxy A15 5G at 2%. Samsung Galaxy A15 4G at 1.8. And then you've got the iPhone 14 at 1.6. Samsung again, A55 at 1.5. And then the Redmi by Xiaomi coming in at 1.5%. If you aggregate those in terms of the top 10, I'll just do them on the go here. 4.1, call it 8, 11, 13, 15, 17, 19, 20 and a half, and then 22, rounded down about a 1%. So 10 phones will roughly 21% or 20% of global smartphone sales are from 10 makes. And the only phone in that top 10 that is not Samsung or Apple is your Xiaomi, which is Chinese. All right, let's have a look at Chinese mainstream apps, including WeChat and Zhuangzhu and Taobao, are testing a new national cyber ID system with a draft rule proposed by the country's cyberspace regulators still in stage for soliciting public feedback until August 25. I'll summarize this for you. Basically, I don't know if you've got this in your country where you are. If you do, let me know. I'm sure you do. It's got like a Veda, we call it a Veda test here, where when you set up, let's say, an online trading account or a bank account or something like that, you enter your name, your address, and maybe your driver's license number or your passport number, and there's like a national system check that verifies that's you. I believe this system check is coming in, rather than just verifying according to your ID number and your name and your address, it verifies you according to your face, and then you're able to set up a bank account, a trading account, insurance statements, whatever that is. This is market leading. I recently interacted with Chinese cyber ID when I set up an online crypto account for a crypto tip that someone gave me. I'm not going to say it online. And it was a crypto platform called GateX or GateXIO, something like that. And they were using MEG-V technology for when you had to put your face and then send your ID so they could verify that was you. More than 70 apps are participating in the beta test, where users are asked to log in via the virtual number, which they get from an official app after finishing steps including ID verification, facial recognition, mobile phone linking, and setting up of an 8-digit password. The reason why I bring this in is this is market leading, this is world leading. And when you talk about cybersecurity, regulating cyber, regulating AI, regulating the internet, then there is no other country in the world that's attempted to regulate it, whether you agree with it or not, like China has. And if you talk about tech regulation, which we saw 3 or 4 years ago, it was about ensuring that tech was on the plane already for the next 40 or 50 years as it evolved. So I thought that was an interesting point that came out. Let's have a look at another one. Tesla sets up an insurance subsidiary in China. Tesla continuing to do business in China. Who said foreign companies can't do business on the mainland? Tesla is making a renewed push into China's insurance market with establishment of a wholly owned subsidiary with registered capital of 50 million RMB or renminbi or 6.92 million in US dollars roughly. And its chief, Tom Zhu, as a legal representative in Beijing. The new company called Tesla Insurance Brokerage was established on June 30 and sole shareholder of the new company is Tesla Insurance Services, wholly foreign-owned enterprise owned by Hong Kong. Of course, Tesla still needs to gain approval from Chinese financial regulators, but Tesla and the Chinese regulators have had a very good relationship thus far, so I think that's going to happen. Obviously, Tesla is selling a lot of EVs in China. It's their biggest market outside of North America. I think it's their biggest market per se, and therefore getting into insurance is a good vertical. Is it vertical or horizontal integration? It would be horizontal. No, it'd be vertical integration into that market. Cattle, who I believe is the best company in China at the moment. Unfortunately, as foreigners, we can't own it directly because it's only listed on mainland bourses. They've pushed a little deeper into flying cars on August 3rd when Autoflight, a Shanghai-based electric aircraft startup, announced it will raise several hundred millions in US dollars in a fundraising round from the electric vehicle battery giant. Cattle will take the slot of Team Global, a technological holding company founded by German-Polish entrepreneur Lukas Godolski, and an existing and major investor of Autoflight, making it the second biggest shareholder after Tian Yu, founder of the company, sources told Caixin Global. Next, BYD, Sherry, and Cattle make it onto the 2024 Fortune 500 list. If you don't know what the Fortune 500 list is, it is the 500 biggest companies in the world via revenue. This is via the TechNode feed. So Chinese automotive companies had a strong presence on the Fortune magazine annual list of 500 top global businesses. Now remember, this doesn't measure you by market cap, it measures you by revenue. Electric vehicle giant BYD rose 69 spots on the 2024 Fortune 500, recording the biggest jump by a Chinese automaker to rank the company 143 in revenue, 143 largest by revenue, by revenue. Rival Geely saw its ranking rocket to 185 this year. If you don't know who Geely is, if you're around the world and you've ever seen a Polestar, that is a joint operation between Geely and Volvo. The Volvo parent is also one of the only two privately owned Chinese automakers on the list. State-owned SAIC was the highest-ranked Chinese automaker, although the partner of Volkswagen and General Motors fell 9 spots to 93%. A lot of Chinese automakers on that list because China is now the largest automaker exporter in the world, overtaking Japan. Peers FAW 129, GAC 181, and BAIC 192nd, as well as Dongfeng Motor 240. And Chinese South Industry Group 343, parent of Chang'an Automobile. So a lot of automobiles makers on there. Tencent has joined Moonshot AI in a $300 million funding round. If you don't know who Moonshot AI is, it's one of China's little AI dragons. It is a chat GPT-like Kimi creator. It has received funding from Alibaba and now Tencent. So the cash injection into Moonshot's AI appeared to be the wager on the most promising companies to stand out in the business competition field. The WeChat owner launched its Huanon AI model in September 23, and its Wanbei AI app powered by Hinwan, I'm butchering these pronunciations, in May this year. I will say that China's AI space is hotting up. Take a look at SenseTime and its move there. MegV, another one you should watch out for. It's not listed, so you can't buy it. There's also the move that there's a couple of races. There's the race in the ChatGPT LLM model. I think I've said this before. I think Baidu was out ahead, particularly with its Ernie bot. You've also got the text, the image, text, the video. Players there are Tencent, Alibaba, and Kuaishou, which I think is a little player that you should look at in terms of that. So it's a hotting up space with a lot of money coming out. You don't necessarily hear about it, read about it, or see about it, but China's AI space is coming, and it's coming with a vengeance. You heard this here first, second, and last because I've said it for the last couple of months. All right, so let's talk about, global markets. We did touch upon this in the market review, and I am filming this in sections. this week because I'm going away and I wanted to make sure I get it out. But we obviously had the massive move we saw. And if you're watching this on YouTube, you can see a little chart that I've put up there. And if you're listening to on podcast or whatever it is, I'll spell it out. So we had the Japanese move 12.23% in a day, downside. On that same day, we saw Taiwan move 8.3%. South Korea move 8.35 as well. However, if you look at Chinese exchanges, Hong Kong down 1.46%, Hang Seng Tech down 1.36%, Shanghai down 1.45%, Shenzhen down 2.08%, and the Starboard down 2.95%. Why did Japan move? Well, obviously it was off the back of a horrible couple of days in terms of the US and the bad data that came out there. You had BOG tightening and yen appreciation and that unwinding of that carry trade that we talk about. Taiwan, I think you had massive, heavy, semi-global crowded trade, particularly with TSMC, as well as South Korea. However, if you look at Chinese markets, they held up reasonably well in response to the global sell down that we've seen and the volatility that we've seen. And I thought, well, why don't we run through why this would have occurred? If you're listening on YouTube, you'll see there it says, why did it buck the trend? And there are kind of 5 key factors, I think, why it bucked the trend. The first one is, China's unlike many markets in the world. It's got a key domestic focus. I talked about this on radio on Wednesday, and they asked me the same question. You got to remember, China has kind of been delinking itself. We talk about decoupling. Get on my TikTok channel, which is China's stock market, and I do a really good video on decoupling. The US and China and the West in general have been decoupling from each other for a while. So they've kind of been getting off each other's drip. So they're not influenced as much by US monetary policy, by US economic policy, and by US economic data. It's more of a domestic focus. It's insulated from global trends, which therefore shield it from international volatility. We saw that play out on Tuesday, definitely. Government policy reforms. We did see a whole bunch of reforms. We talked about the fiscal stimulus. We're going to talk about the 20-point plan, which kind of light on detail, but nonetheless came out. So they've implemented various policy measures to stabilize and support the market. For example, the state council has implemented this 20-point plan and the fiscal stimulus, which have bolstered confidence. The other one is they have attractive valuations. They've been shot to shit, I will say, excuse my language, and their valuations compared to other companies are quite attractive, and they have considerable stock buybacks, which we've talked about a number. It's also drawn interest from investors looking for opportunities amid global market uncertainties, and the improving fundamentals, we believe, in sectors such as the internet and e-commerce made people appeal to Chinese stocks with that volatility. Again, there's strong domestic consumption. They're trying to fuel their own companies rather than rely on international expansion, which I know I've talked about their international expansion before. And they've got they're supported by a rebounding services sector and an internal demand which is not quite where they want it, but certainly is showing some signs that is starting to alive. And again, back to point 1, it's got limited exposure to global factors. Right, it's starting to become fairly self-sufficient and in-house, China's economy. And again, they're pretty much blocked off from US markets. Well, in certain industries they are. Obviously in a trade war with Europe at the moment, which is getting better. But they have limited exposure. And therefore, they're kind of a little bit of immune to the global sell-off that we saw. And I think we're going to see continued volatility in markets, particularly with so much unsurety in the world, geopolitical concerns, election, wars, etc. Now, whether we continue to see sell down in global markets or not, I don't know. I tend to be a permeable on most things, but I'm a little bit bearish about what is going on at the moment. And the fact that trades are so concentrated in, your Magnificent Seven, semiconductors and AI plays, which currently basically are situated predominantly in America, with some South Korea, some Japan, and some India. And the Japanese and South Korean semiconductors and AI plays are really linked to the US economy anyway. So it's such a concentrated trade. It takes a lot to unwind that trade, but maybe we're starting to see that unwinding, and maybe we start to see people look for valuations that are attractive. And I tell you what, they look very attractive in the US at the moment. But it did buck the trend, particularly when we saw, and I'll just go back to that little chart that I had here, a little table, when you saw the Japanese market down 12.2, Taiwan down 8, South Korea down 8, Hong Kong was only down 1.46, Hang Seng Tech down 1.36, Shanghai down 1.45, and Shenzhen down 2.08. Interesting there. All right, let's take a look at this piece of news. So this came out on, I'm going to say Monday, the 4th of August. Actually, I think it came in over the weekend. So a statement via the Politburo, and it was kind of 20 key measures to boost consumer spending within China. We talked about last week about 50% of the ultra-long bonds being accredited to households to buy certain goods, washing machines, air conditioners, household appliances, in order to boost demand or boost consumer or consumption. Kind of checks in the mail, kind of what happened in Western countries during COVID. And then we saw a further statement around a 20-point plan, which was called on promoting high quality development of services consumption. There is also a press conference slated for this Friday, which will be the 9th of August. We won't cover it in this session because we go from Friday to Thursday. But, another move by Chinese regulators to boost consumer demand. Now, I talked about last week about China having no interest in becoming a consumer-based economy, and that they were moving, they were full point ahead around, being an export-driven market and being the Amazon of manufacturing. However, in saying that, they understand that they need to boost consumer demand somewhat in order to get growth coming and to kind of, how do I put it, to kind of alleviate some of the property worries that's considered that that's making consumers put their money under their beds and save that. So they announced it through the State Council. It was light on detail. It was focused on increasing domestic demand to support economic growth. They did it for all the things that we've talked about before. Economic growth is slowing. I think the 4.7 number that we saw, where annual growth was supposed to be at 5% or targeted at 5%, I think sent some shocks through the waves. We saw interest rates lowered off the back of that by the central bank within China. So they're trying to achieve that. They have strong export numbers, but they really want consumer spending to rise somewhat. And I think policymakers are under pressure to provide government support to stimulate the economy and to achieve some of the factors that were announced in the third plenum just under a month ago. The key points of the plan, and again, they were light on detail, but I'll run through. Expand basic consumption in areas such as catering, home services, and elder care. If you go off the back of the stimulus checks, I'll call them, we saw stocks such as Media really rise, and JD.com, because it kind of caters towards that. Foster new spending type in things called unmanned retail stores and self-pickup lockers. They wanted to support esports and live streaming e-commerce plays. So you have a look at some of that, like Youku, for example. They wanted to enhance financing support. So more money, which I think is a good motive for small and micro enterprises in the service industry. They are implementing tax deductions. If you don't know, China is actually overhauling its tax structure, which I think will be very beneficial. If you talk about the third plenum, one of the key components of the third plenum that I think was very missed was the fact for a financial law to be implemented, which is non-existent in China, like a standard financial law on how things operate in one area. They have laws, obviously, but it hasn't been reformed and hasn't really been developed. They also talked about encouraging leisure tourism in areas such as cruise ships, yachting, and low altitude flying, whatever that means, and increased credit support. So look, we're seeing a lot of rhetoric, which usually is a good sign, because what we know about Chinese regulators and enterprise institutions, they usually do what they say they're going to do if they want to push something. So the State Council statements, here's some quotes from the State Council there. Exploring the potential to expand basic consumption in areas such as catering, home services, and elder care. Cultivate unmanned retail stores and self-pickup lockers. The Communist Party is pledged to make boosting consumption a greater policy focus, and tax deductions for family-related expenses. So more rhetoric and more moves on the consumer side, which I think will be beneficial in the short term and the long term for Chinese stocks. So just further to that point, I wanted to just make some comments or show some quotes from this South China Morning Post article around, Chinese stocks remaining steady in the face of wild gyrations. And we covered just previously some of the points around it being a closed market, a lot of government stimulus, China kind of detaching itself from the global economy as much as it can, considering it's the largest exporter in the world. However, this was saying that Chinese stocks are considered attractive due to favorable market valuations, equity risk premiums for the CSI 300 and the Hang Seng Index have rebounded to high levels, including potential investment opportunities. It went on to say that mainland China's relatively stable stock market could attract more investors. Analysts note that smart money may already be moving into Chinese stocks. Goldman Sachs reports that global hedge funds have slightly increased their exposure to Chinese stocks because of the market volatility. And I'll end the video on a quote by Brendan Hearn, who's the Chief Investment Officer for Crane Shares. I actually emailed him after this. He wrote me a really nice email, not too long, but saying, thanks for the comment, and that he was about to go to bed. And he said it takes a long time to turn a big boat. But this is his comment that he made on the 8th of August following the trading of the 7th of August around the world. Asian equities rebounded as the yen weakened by 1.88% versus the US dollar overnight, after the Bank of Japan's Deputy Governor, Shinichi Uchida, stated that they won't hike further if there is market turmoil. This implies to me that more hikes are coming at some point, right? Now, the reason why that is massive is because the playbook has been to borrow in yen at zero rates and invest that in global equities, particularly US tech, to get growth, right? That's the carry trade, the free carry trade, right? Borrow in yen, zero rates, cheap, go and buy US equities and get growth and play that playbook. And that, to some extent, has contributed to some of the rally that we've seen, particularly in US equities. There's no doubt about that. The further thing he commented about a couple of days earlier is the concentration trade. The fact that, it's the Magnificent Seven with some specific AI plays in the US, Japan, South Korea, and India to some extent, and semiconductors, right? ASML in Netherlands, and then these are the concentrated trades. This is where most of the world's money is in. It's the most concentrated trade probably in global history. And it takes a lot to unwind that trade. So then he wrote, a higher yen would mean quote, the only playbook you can discard is the playbook you've had for decades, according to consultant Stephen Miller in a Bloomberg article. Could that reverberate across other perennial winners, wrote Brendan Hearn, such as the 15-year winning streak of US equities versus non-US equities and the stronger US dollar since 2011, right? You've got to have a strong US dollar, money flowing into US equities. Time will tell, though no one is positioned for a market regime change. Could this be the Great Unwind? is what he's trying to say. And could we see a move back to historical norms where there are periods where emerging markets, i.e. China, outperform developed markets, i.e. the US? And could there be a regime change for a market leader? Now, some people would call me an absolute crazy man to say that it is possible. However, I continue to say that China is the most important economy in the world. And China will be the most important economy, or the biggest economy in the world, or the most economically dominant economy in the world going forward. If you look at new industries and the players in tech, yes, US is still the leader, but second, and firmly second, is China. And I don't believe they have the fundamental structural problems and are part of the concentration trade like the US is at the moment. I'm not saying the US is going to go. I'm just saying there could be, like Brendan is affirming here, a regime change. It's going to be a bumpy end to the year. I'm going to be right here every week covering it for you. Please tune in. Once again, leave me a comment on YouTube, a 5-star review, or whatever you do on podcast, wherever you listen to it. Thank you very much. We'll be back in my office next week filming this in one part rather than 2 parts. And as always, good luck with your investing.